Okay, let's unpack this. Imagine the relief, finally. It's over. You've been through a stressful legal battle, maybe an injury claim, a property dispute, or a workplace issue, and you've reached a settlement.
Right. Or maybe you got a big insurance payout.
Exactly. You have the check in hand, and that first wave of relief just washes over you. But almost immediately, that little voice starts whispering.
The tax question.
Is this money taxable? Does a huge chunk of this belong to the IRS? For so many people, that seemingly simple question, well, it cracks open a Pandora's box of confusing, often counterintuitive U.S. tax rules.
It really does. And getting it wrong can mean a massive, unexpected tax bill months, maybe even years down the line.
It's like a hidden landmine in the landscape of legal resolutions.
It truly is. And the default assumption people might have, that maybe all settlement money is taxable, but maybe none of it is. That's almost always wrong. The reality is complex, highly specific.
And it depends on details most people aren't even thinking about from a tax perspective.
Exactly.
Welcome back to The Deep Dive. Today, we are taking a serious look at a stack of sources. We've got guidance straight from the IRS, analysis from tax attorneys who, live and breathe this stuff, and even real-world scenarios people have wrestled with.
Yeah, a good mix.
Our mission for this deep dive is to cut through all that confusion surrounding the tax treatment of lawsuit settlements and damages in the U.S. We want to give you the essential knowledge, help you understand the critical distinctions, the things that make the difference between tax-free money and fully taxable income.
And uncover some surprising facts that could genuinely shock you.
Right. And most importantly, help you avoid the kind of costly mistakes that turn a hard-won settlement into, well, a tax nightmare. We're going beyond the headlines today to really unpack the rules, the paperwork.
And why planning before you get the money is absolutely mind-blowingly crucial.
It's fascinating, isn't it? Because the tax code doesn't just look at the dollar amount on the check.
No, it looks behind the payment. It tries to understand its true nature. What's it really for?
And that, right there, that's the foundational principle. It's the key that unlocks everything else we need to understand. When we talk about the taxability of a settlement payment, the very first question you have to ask is, what is this money for?
What was the origin of the claim? What was the cause of action that led to this payment?
Think of the settlement amount not just as cash, but as a replacement for something else.
That's a great way to put it. The IRS views that money as stepping into the shoes of whatever you were claiming compensation for in the first place. So the taxability follows the taxability of the original item.
So if your original claim was trying to get back something that would have been taxable income anyway, like lost wages,
then the money you get in settlement for that lost wages claim is likely taxable income. But if your original claim was for something the tax law specifically says is not income,
then the settlement money for that is likely not taxable.
Exactly. You have to look at what the money's replacing. Was it lost profits from a business? Damage to your property? A physical injury? That's where the whole inquiry begins.
It's like figuring out the DNA of the money. You trace it back to its source claim. And speaking of sources, one of the most significant areas where settlement money is not taxable comes directly from a specific section of the U.S. tax code.
Ah, yes, Section 104A2.
This is often the biggest piece of good news for plaintiffs, but it comes with some really critical caveats.
That's right. The most well-known exclusion is for damages received on account of personal physical injuries or physical sickness. The law is quite specific here.
And this is where the confusion often starts, right?
Yeah.
Because the legal term personal injury is super broad. I mean, it can cover harm to your reputation, emotional distress.
Even contract breaches in some legal contexts, yeah. But for tax purposes, that phrase, personal physical injuries or physical sickness, is much, much narrower.
So the tax exclusion only applies when the payment is a direct result of that physical harm?
Precisely. The money must be on account of the physical injury or sickness. Our sources really emphasize this distinction.
Okay, let's make this concrete. We saw an example in one of the sources. Imagine a shopper in a big store. A display, maybe poorly built, collapses on them.
Right? Causes, say, a broken arm and a concussion. Physical injuries.
So they need hospital treatment, maybe surgery. They miss work for weeks, need physical therapy. They sue the store. The lawsuit claims money for the physical injuries themselves, the medical bills, the lost wages because they couldn't work due to the injury.
And maybe something for the store's negligence, too.
Okay, so in that scenario, the money the shopper gets in a settlement that's specifically for the broken arm and concussion, the physical injuries, and the medical expenses they incurred because of those physical injuries, and the wages they lost because they were physically unable to work. That portion is generally excludable from their taxable income.
Right. The tax law sees that as making the person whole again from the direct physical harm and its immediate consequences.
Yeah.
It's not seen as providing them with new income.
So if you're in a car crash, break your leg, the money for the leg itself, the doctor bills, the weeks you missed work because you couldn't walk, typically tax-free.
Or, another example could be health problems years later from exposure to some toxic substance. Compensation for those resulting physical illnesses would likely fall under this exclusion.
Okay, now here's the part that seems to trip up so many people, and it's a major source of tax disputes: emotional distress.
Yes. Emotional distress. Damages received solely on account of emotional distress are generally taxable income.
Even though legally, emotional distress might be called a personal injury.
That's the catch. For tax purposes, it doesn't automatically qualify for that physical injury exclusion.
Okay, so if I sue someone just because they caused me severe stress and anxiety, maybe workplace harassment, but there was no physical contact, no actual physical injury involved, any settlement I get just for that stress and anxiety is taxable.
That's the general rule, yes. However, and this is where it gets a bit complex, but it's really important that there's a crucial nuance. Our sources, especially one looking at the legislative history in court cases, really highlight this.
Okay.
If the emotional distress is attributable to a physical injury or physical sickness, then damages for that emotional distress are excludable.
Okay, let's break that down. This is confusing. Let's use a couple of scenarios, like the sources did. Scenario A. Back to the car accident. You break your leg, that's the physical injury.
Right.
Because of the severe pain, the long recovery, maybe the trauma of the accident itself, you develop significant anxiety and depression.
Okay.
If you get compensated for that anxiety and depression in the settlement because it resulted from or was attributable to the broken leg,
Then that compensation is tax-free. It flows directly from the physical harm.
Got it. Okay. Scenario B. You have a horrible experience at work, severe harassment, let's say, but it's not physically threatening. It causes immense stress, sleepless nights. And as a result of that stress, you develop physical symptoms like stress headaches, stomach issues.
Okay, physical symptoms, but from emotional stress.
Right. If you sue and get a settlement just for that emotional distress and those stress-related physical symptoms, and there was no underlying physical injury in the initial harassment,
Then that compensation is generally taxable. Even though you have physical symptoms like headaches, they resulted from emotional distress that wasn't caused by an initial physical injury.
Wow. Okay, so it's not enough just to have physical symptoms. Those symptoms, or the emotional distress itself, must be because of an actual physical injury or sickness sustained in the event you're suing over. That distinction is really subtle.
It is. But it makes all the difference for taxes.
Yeah.
And it's led to a lot of disputes, a lot of court cases.
I bet.
Courts have had to look really closely at settlement agreements, especially when they're vaguely worded, to figure out the true nature of the payment.
Like if it just says non-economic damages or gives a lump sum without breaking it down.
Exactly. The sources mention specific tax court cases like Dominy and Parkinson. In those cases, the settlement agreements were ambiguous. So the court didn't just guess. They looked back at the origin of the claim as pleaded in the original lawsuit complaint.
What did they find?
Well, in Dominy, the taxpayer had MS that was worsened by her work environment, then she was terminated. The agreement was unclear. The court looked at evidence showing her MS symptoms got worse, she couldn't physically work. Based on that, they inferred part of the payment was for physical injury sickness and allowed an exclusion.
And Parkinson.
Similar idea. Taxpayer had heart attacks, sued the employer, claimed the job contributed. Settlement just said non-economic damages. The court analyzed the complaint, which alleged physical injury, effects on the cardiovascular system. They decided about half the payment was on account of physical injury sickness, so that half was tax-free.
So the key takeaway from those cases is, if the settlement agreement is fuzzy, courts will dig into the original lawsuit claims and evidence to decide what the money was really for.
Precisely. Which just underscores how critical clear documentation is, especially in the settlement agreement itself. Clearly, allocating the funds to specific types of damages is best. If you don't,
You leave the door open for the IRS or a court to decide for you, and maybe not in the most tax-friendly way.
you got it.
Okay, so physical injury and related damages, potentially tax-free. Emotional distress not tied to physical injury or physical symptoms from standalone emotional distress, generally taxable. Okay. Now, what about the money you get that is almost always taxable, no matter what the original claim was about?
Right. There are two really big categories here that are almost universally treated as taxable income. Punitive damages and interest.
Punitive damages, these are the huge numbers you sometimes hear about in high-profile cases, right? They aren't really about compensating the victim for their loss.
Exactly. Their purpose is totally different. As sources like advocates explain, punitive damages are meant to punish the defendant for particularly bad, maybe reckless behavior.
And to deter others from doing the same thing.
Right. It's about penalty and deterrence, not compensation for the plaintiff's specific harm.
So how does the IRS treat that money?
The rule is crystal clear. Almost no exceptions. All punitive damages are taxable as ordinary income. Period. Full stop.
Even if the underlying lawsuit was for a physical injury, like our car crash example.
Doesn't matter. Even if the compensatory part for the broken leg is tax-free, if the jury also awards punitive damages because the driver was, say, extremely reckless, that punitive portion is separate and fully taxable.
The famous McDonald's hot coffee case, some sources mention that one. That's a perfect example, isn't it? Stella Liebeck suffered severe burns, a terrible physical injury.
Burns, yeah.
The jury awarded her compensatory damages for those injuries, which would generally be tax-free, but they also awarded a massive amount in punitive damages to punish McDonald's for their conduct regarding the coffee temperature.
Right, and that large punitive award, even though it stemmed directly from a case involving severe physical injury, was fully taxable income to Mrs. Liebeck.
That case really drives home the rule. Compensatory for physical harm is one thing. Punitive is another animal entirely for tax purposes.
It illustrates it perfectly.
Okay, and what about interest?
Any prejudgment or post-judgment interest awarded as part of a settlement is also always taxable as ordinary income.
Why is that?
The tax law just views this interest like interest you'd earn in a bank account. It's considered income earned on the money itself, separate from the underlying claim's original nature.
So, back to the car crash again. The main compensation for the broken leg is tax-free. But if the case took years and the court awards interest on that tax-free amount, that interest portion is suddenly taxable income.
Correct. Punitive damages and interest are specific add-ons that break that general rule about the origin of the claim. They're always taxed.
Okay. Beyond those specific, always taxable items, what other types of settlements are typically going to land you with a tax bill?
Well, compensation for lost wages or lost business income is generally taxable.
That makes sense.
Yeah, the reasoning is pretty straightforward. If you had earned that money normally, it would have been taxed. So money you get that replaces that lost taxable income is also taxable. Very common in employment lawsuits, for instance.
And we covered standalone emotional distress, but just to nail it down again.
Yes. Compensation received solely for emotional distress, meaning not stemming from a physical injury or sickness, is generally taxable income. Now, one source mentioned you might be able to reduce that taxable amount by certain related medical expenses you paid for the emotional distress but couldn't deduct before. But the core recovery for the emotional harm itself is still taxable.
What about settlements from things like wrongful termination or discrimination based on age, race, gender, disability, that sort of thing?
Those settlements, received for claims alleging illegal discrimination, are typically treated as taxable income. The IRS often sees these as replacing lost employment income or compensating for non-physical harms.
Okay, let's switch gears completely for a second. What happens if a settlement isn't about personal harm at all, but about damage to your property? Say your house was damaged in a storm or land you own was contaminated.
Property damage settlements. They have a different specific rule that ties into your basis in the property.
Basis. That's essentially your investment in the property, right? What you paid for it plus improvements, maybe minus depreciation if it's business property.
Exactly. It represents your cost for tax purposes.
So what's the rule for property damage settlements?
Okay. If the settlement amount you receive for damage to your property is less than your adjusted basis in that property, the settlement is generally not taxable.
Oh, okay. So what happens then?
Instead of being income, you have to reduce your basis in the property by the settlement amount. It's seen as you just recovering part of your original investment, your cost.
So if my house costs $300 case, that's my basis, and I get a $15 case settlement for roof damage from a storm, that $50K isn't income, but my new basis in the house is $250K.
Exactly right. You've recovered some of your cost. However, if the settlement amount exceeds your adjusted basis in the damaged property,
then it is income.
yes, The amount of that excess is considered income.
And how is that excess income usually treated, like ordinary income?
It's typically treated as a capital gain. You need to report this on specific tax forms like Schedule D or maybe Form 4797, depending on what the property was and how you used it.
Okay, this came up in a real-world scenario one of our sources described actually from a Reddit thread someone found. A person got a $20 case settlement because trees were clear-cut and their land was damaged. After legal fees, they netted less, maybe $17K.
Right. And they were asking if the whole $20 K was taxable.
Based on this rule, the answer depends entirely on their adjusted basis in that specific damaged part of the land, doesn't it?
Absolutely. If their basis in that damaged area was, say, only $5 K, then $15K of the $20 K settlement would be taxable capital gain.
But if their basis in that land was $25K or more,
then none of the $20 K settlement would be immediately taxable. They'd just reduce their basis by $20 K. They only recognize gain, and thus taxable income, after they've recovered their entire cost in the property.
that's a great illustration of how basis works there. Okay, so we've navigated what types of settlements are generally taxable and which aren't. But there's another layer of complexity, and honestly, for many plaintiffs, this is where the biggest tax pain point seems to lie. Legal fees.
Oh boy.
You almost always need a lawyer to get a settlement, especially a significant one, and they need to get paid, usually a percentage.
This is arguably the most frustrating and, frankly, least intuitive aspect of settlement taxation for individuals, especially under current law.
Why's that?
Well, the general principle, which has been upheld by the Supreme Court in a case called Banks, is that when your attorney receives a portion of your settlement as their contingent fee, that portion is generally considered part of your gross income first, before it goes to them.
Wait, really? So even if the settlement check goes straight to the attorney's trust account and they take their 40% cut and send me the remaining 60%, the IRS views it as if I received the full 100% and then paid my lawyer out of my pocket.
In simplified terms, yes. The attorney is seen as your agent. The gross settlement amount is attributed to you. And often the payer of the settlement will issue a Form 1099 in your name for that full gross amount, which includes the attorney's fee, further reinforcing this idea for the IRS.
Okay, all right, so the gross amount is potentially income, but surely you can deduct the legal fees you paid your lawyer. I mean, they were absolutely necessary to get the money in the first place.
This is where the Tax Cuts and Jobs Act of 2017, the TCJA, delivered a really painful blow to many individual plaintiffs.
Okay.
For tax years 2018 through 2025, the TCJA suspended something called miscellaneous itemized deductions, subject to the 2% floor for individuals. This category used to include things like unreimbursed employee expenses and, critically for this discussion, legal fees related to most taxable settlements.
Hang on. So for taxable settlements received during this period, 2018 to 2025, you can't deduct the legal fees.
That is the harsh reality for most individual plaintiffs receiving taxable settlements during these years. If you receive taxable income from a settlement, say, punitive damages, interest, lost wages not related to physical injury, standalone emotional distress, and you paid your attorney a contingent fee out of that settlement, you are taxed on the entire gross amount awarded, including the portion that went directly to your attorney. You generally cannot deduct that attorney fee portion as an individual during these years.
This is where that example from one of our sources becomes incredibly stark. I think it was Amicus. They used an example. Plaintiff is awarded $5 million in punitive damages.
Okay, and we know punitive damages are 100% taxable.
Right. Their attorney has a 40% contingent fee agreement. So the attorney takes $2 million, the plaintiff receives $3 million net.
Still sounds like a lot.
But wait, under the current TCJA rules, the plaintiff is taxed on the full $5 million gross award.
That's exactly right. The tax bill on that $5 million, depending on the plaintiff's tax bracket and state taxes, could easily be, say, $2 million or even more.
More than $2 million in tax on $5 million gross.
It's entirely possible. Which means the tax liability on the gross $5 million award could actually exceed the $3 million the plaintiff netted after paying their attorney.
So you could literally win $5 million, receive $3 million after fees, and then owe more than $3 million in taxes. You could end up owing money.
It's a very real and, frankly, horrifying possibility for individual plaintiffs with large taxable settlements involving punitive damages or interest during this 2018-2025 period. It feels profoundly unfair being taxed on money you never physically touched because it went straight to your lawyer.
That just seems wrong. Taxing someone on money used purely to achieve the judgment or settlement in the first place.
It's a direct consequence of this specific temporary change in the tax law regarding miscellaneous itemized deductions. Now, It's worth noting how legal fees are treated in other situations because it highlights the disparity.
Okay.
Legal fees related to a non-taxable settlement, like our physical injury example where the recovery itself is tax-free. Those fees are also generally not deductible.
Oh, why not?
Because tax law generally says you can't deduct expenses
Yeah.
related to earning tax-exempt income. Section 265 of the code. That makes a bit more intuitive sense. Maybe you don't get a tax break for costs associated with getting tax-free money.
Okay, different reason, same outcome. Non-deductible. What about fees for business lawsuits?
If the legal fees relate to a lawsuit concerning your trade or business, say, you own a store and have to defend against a slip and fall, or you sue a supplier for breach of contract, those fees are generally deductible as a business expense on Schedule C or your business return.
And purely personal lawsuits, like suing your neighbor over a fence line.
Those legal fees are generally not deductible at all. They're just considered a personal expense, unrelated to producing income.
So the deductibility of legal fees really depends heavily on the nature of the case and the taxability of the recovery, with this huge, painful exception for taxable individual settlements right now between 2018 and 2025.
That's the big takeaway.
Yeah.
And it shows why you absolutely must understand the tax consequences, including the fee implications, before you agree to any settlement amount or structure.
Absolutely. Okay, understanding the taxability is one huge piece. Another is dealing with the actual paperwork the payer might send you, or your attorney, specifically Forms 1099 and W-9s. These are basically how the IRS learns that you received money.
Right. Payers, usually the defendant or their insurance company, assuming they're acting in the course of a trade or business, are generally required to tell the IRS about payments of $600 or more they make. They do this using various types of Forms 1099.
And there are different types, but the one most often associated with taxable settlements is the 1099 MISC, right? Miscellaneous income.
Yes, that's frequently used. You'd often see taxable amounts like emotional distress or punitive damages reported in Box 3, other income. But you might also see a 1099 NEC for non-employee compensation, maybe if the plaintiff is a business or independent contractor, or a 1099 INT just for the interest portion.
What about property damage settlements that result in a capital gain?
That might involve forms related to real estate sales, like a 1099-S, or security sales, like a 1099-B, depending on the property.
Yeah.
The main point is, these forms are information reports sent to both you and the IRS.
And payers often report the full settlement amount, including the attorney's fee, right? We touched on this. There's a special box on the 1099 MISC, Box 10.
Correct. Box 10 is specifically for gross proceeds paid to an attorney. Defendants or insurers often report the entire amount paid into the plaintiff's attorney's trust account in this box. Now, importantly, this Box 10 amount is mainly informational for the IRS about the transaction flow. It's not typically treated as income to the attorney by the IRS computers. The attorney reports their actual fee income separately based on their records.
Okay, and this ties back to that idea of the attorney being your agent. The payer sends the money to your agent, the attorney, and that payment is essentially viewed as being made to you.
Exactly. The IRS has regulations, sometimes called the middleman rules, that clarify who is considered the payer for reporting purposes when money flows through an intermediary. In a typical contingent fee setup, the plaintiff's attorney who receives the settlement check from the defendant is not generally considered the payer of the net amount they then give to the client.
So the attorney doesn't usually issue a 1099 to their own client for the net amount.
Generally, no. They're acting as the client's agent. Issuing another 1099 to the client could be really confusing and imply the client received additional income beyond what the original payer, the defendant insurer, reported on their 1099 to the plaintiff. Could lead to double reporting issues.
Okay, that makes sense. So the defendant insurer reports the gross amount to the plaintiff, often including the attorney fee amount, and might report the gross payment to the attorney in Box 10. But, and this seems crucial based on our sources, especially the ones from tax law firms, there are important exceptions to when a payer is even required to issue a 1099 MISC to the plaintiff in the first place.
This is absolutely vital for plaintiffs to understand. A Form 1099 MISC is generally not required for payments that are not includable in the recipient's gross income. The IRS instructions themselves state this pretty clearly.
And this specifically includes our big one, the physical injury exclusion.
Yes. The IRS instructions for Form 1099 MISC and NEC explicitly say, do not report damages, other than punitive damages, received on account of personal physical injury or physical sickness. So if your settlement is purely for a qualifying physical injury or sickness under Section 104A2, The payer should not issue you a 1099 MISC or NEC for that amount.
Wow, that's huge. If your settlement is genuinely tax-free under the physical injury rule, you shouldn't even get a 1099 for it from the payer.
That's the rule as written. And a similar logic often applies to capital recoveries, like our property damage example, where you're just getting your basis back.
Oh, so?
Well, remember, only the amount exceeding your basis is taxable gain. The payer often has no idea what your basis is in the property if they can't accurately determine the taxable portion of the payment, if any. Then 1099 reporting to the plaintiff for the property recovery amount itself may not be required or appropriate according to IRS guidance.
One of the sources, I think Wood LLP, cited that massive wildfire settlement example in California PG&E and Southern California Edison. They paid out billions to victims for property damage, other losses.
Right, a huge situation.
According to the source, those utility companies did not issue Forms 1099 to the individual victims for their settlement recovery amounts.
Right.
Because they lacked the necessary information specifically, each victim's basis in their destroyed or damaged property to accurately determine the taxable gain, if any, for each person. They did apparently report the gross proceeds paid to the law firms handling the cases in Box 10, but not the individual recovery amounts paid out to the clients.
That's a powerful real-world example. It shows that large, sophisticated payers, when dealing with recoveries where the taxability depends heavily on the recipient's specific circumstances, like physical injury status or property basis, do sometimes follow the rules and guidance and correctly not issue a 1099 to the individual plaintiff for the portion that isn't clearly gross income to them.
Okay, so the rules say you shouldn't get a 1099 for non-taxable amounts like physical injury, and sometimes not for capital recoveries where the gain isn't known by the payer. But what happens in practice? It sounds like many defendants still issue 1099s anyway, even when these exceptions seem to apply. Why the disconnect?
Yeah, that definitely happens. As the sources explain, it often comes down to the payer's perspective, maybe their internal accounting or legal departments. Their default setting is often payment over $600 made in course of business, issue a 1099.
Just to be safe.
They tend to see it as this safer approach for them. They're worried about potential penalties for failing to file an information return if one was maybe required. Some might also mistakenly believe issuing the 1099 is somehow necessary for them to take their own tax deduction for the settlement payment, which it isn't. Their deduction is based on the payment itself, not the reporting form.
So they're more worried about a penalty for not sending a form than they are about a penalty for potentially sending an incorrect form, like one reporting tax-free income.
That often seems to be the practical calculation for many payers. And receiving an unnecessary or incorrect 1099 is a problem for the plaintiff, the recipient, because it automatically flags your tax return with the IRS. Their computer matching systems expect you to report income shown on any 1099 issued under your Social Security number. So if you get a 1099 for tax-free money and don't report it, which is correct, you'll likely get a notice from the IRS.
And then you have to explain.
Exactly. It forces you to explain why some or all of that amount isn't actually taxable. This can mean letters, maybe providing documentation, potentially even triggering unwelcome correspondence audits, and all the associated costs and stress, even if you ultimately prove the money was indeed tax-free.
Which is exactly why dealing with this before the settlement is signed is so critical. We keep coming back to that.
We do.
But sticking with paperwork for just one more moment, besides the 1099, defendants will almost certainly ask the plaintiff for a Form W-9. What is that, and what should you do about it?
A Form W-9 is simply a request for taxpayer identification number and certification. The payer needs your correct taxpayer ID number, usually your Social Security number, SSN, or sometimes an employer identification number, EIN, if you're a business, to correctly issue a 1099 or maybe a W-2 if one is ultimately required. They request this W-9 to comply with their reporting obligations and avoid potential issues on their end.
Okay, what if a plaintiff thinks, my settlement isn't taxable, I don't want a 1099 anyway, so I'm just going to refuse to give them my SSN on a W-9. Can they just do that?
Ooh, that is a very risky move and generally not advisable at all.
Why not?
Because if the payer determines that a 1099 is required for any part of the payment, or even if they mistakenly believe it's required and plan to issue one, and you refuse to provide that W-9 with your TIN, the law requires them to initiate backup withholding.
Backup withholding? What's that exactly?
It
Sounds bad.
It is bad for the recipient. It means the payer is legally required to withhold a percentage of the payment currently a pretty hefty 24% at the federal level, plus potentially state withholding on top of that, and send that money directly to the IRS and the state tax authorities.
And they send it without your Social Security number.
Usually, yes, or maybe with a placeholder number.
Yeah.
And that makes it incredibly difficult, sometimes nearly impossible, for you, the plaintiff, to get credit for that withheld money when you eventually file your tax return.
Why?
Because the IRS doesn't have a record of that withholding being associated with your specific SSN. You'll likely have to go back to the payer, probably provide the W-9 anyway, so they can issue a corrected 1099 showing the withholding in your SSN, and then jump through bureaucratic hoops with the IRS or state to claim credit for the money that was taken out months or years before.
That sounds like a nightmare. You could effectively lose that withheld money.
It's a major hassle. And yes, in some cases, people can effectively lose track of or be unable to claim that withheld money if they don't navigate the process correctly and within certain time limits. There can also be penalties for willfully failing to provide the W-9 when requested if reporting is required.
Okay, so the bottom line is, even if you are 100% confident your settlement is tax-free and a 1099 shouldn't be issued, providing the W-9 when asked is usually the smartest way to avoid this whole backup withholding headache.
In almost all conceivable situations, yes. The potential pain, cost, and complications from backup withholding far, far outweigh the annoyance of potentially receiving an incorrect 1099 that you then have to explain on your tax return. It's almost always best to provide the W-9 and then deal with any incorrect 1099 reporting later, perhaps by negotiating with the payer before they issue it or by explaining it properly on your return.
This all brings us right back full circle, doesn't it? To the most important takeaway from everything we've discussed, and really from all our sources. Proactive planning is not just a good idea, it is absolutely essential.
Cannot stress this enough.
The best time, maybe the only effective time to address the tax implications of a settlement is before that settlement agreement is signed.
Absolutely. Once the agreement is signed and finalized, you, the plaintiff, lose almost all leverage. You can't easily go back and influence how the payment is characterized for tax purposes, how it's allocated among different types of claims, or how the payer agrees to report it or not report it on Form 1099.
So getting clear language in the settlement agreement itself is paramount.
It's critical. The sources from the tax law firms emphasize this again and again. The settlement agreement should ideally explicitly allocate the total payment amount among the different types of damages being compensated.
Like spelling it out. $6 for physical injury under 104A2, dollars for related medical expenses, $Zeller for taxable emotional distress, $Zeller for punitive damages, dollars as recovery of property basis. That level of detail.
That's the ideal, yes. Clearly stating how much is for physical injury, citing the code section can help, how much for emotional distress, and specifying if it's tied to the physical injury or standalone, how much for lost wages, how much for punitive damages, how much represents a recovery of property basis, and so on.
And while we know courts can look behind ambiguous agreements, having those clear terms up front drastically reduces uncertainty and future audit risk.
Exactly. It makes it much harder for the IRS to successfully challenge the tax treatment later if the agreement itself supports it.
Should people be getting specific tax advice during the settlement negotiation phase? It sounds like it.
For any settlement of significant size, or one that involves different types of potential damages, physical, emotional, punitive, property, etc., or large amounts, consulting with a qualified tax professional who specializes in settlement taxation before you sign the final agreement is highly, highly recommended.
What can they do?
They can review the proposed settlement language from a tax perspective, advise you on the likely tax consequences of different allocation scenarios, potentially help your litigation attorney negotiate specific tax-related language in the agreement, and maybe even discuss with opposing counsel how the payment should ideally be reported or not reported on a Form 1099 according to the actual rules, not just the payer's default habit.
And are there specific planning tools available for certain types of settlements, particularly to help with that really painful legal fee issue we discussed earlier, the non-deductibility for taxable awards?
Yes, there are advanced strategies. One specific tool mentioned in the amicus source is the use of a plaintiff recovery trust.
A plaintiff recovery trust, what's that?
It's a specific type of trust structure designed primarily for cases involving significant taxable recoveries like punitive damages or interest, where that non-deductibility of legal fees under current law creates that potentially massive tax burden on the gross amount.
Okay, and what's the goal of setting up this kind of trust?
The main goal is to structure the receipt of the settlement funds and the subsequent payment of the attorney's fees in such a way that, hopefully, the plaintiff is taxed only on the net amount they actually receive after the attorney's fee is paid out. Effectively, it aims to let them avoid being taxed on the portion that goes straight to the attorney for those specific types of taxable recovery.
Man, does it work?
The amicus source suggests that properly structuring the settlement payment through such a trust, when appropriate, could potentially double or triple the amount of money the plaintiff gets to keep after taxes in these specific types of cases. Punitive damage interest, compared to receiving the gross taxable amount directly without this planning.
Wow. That sounds incredibly powerful, especially given the current tax rules on deducting legal fees for individuals. But I sense a but coming. There's that critical timing requirement again, isn't there?
Yes, and it is absolutely non-negotiable. A plaintiff recovery trust and pretty much any effective tax planning strategy for settlements must be established, and the settlement agreement must direct the payment to the trust before you or your attorney gain receipt or constructive receipt of the settlement money.
So once that check is cut to you or your lawyer, even if it's just sitting in the lawyer's trust account, it's too late.
Generally, yes. Once you have the right to the money, it's usually considered received for tax purposes. And it's too late to implement this kind of structure effectively to change the tax consequences of that receipt.
So the absolute instant, a significant taxable settlement, particularly one involving punitive damages or interest where fees aren't deductible, seems likely. You need to be talking to a specialist tax professional about these planning options immediately.
Absolutely. Delay can literally be the difference between keeping a substantial portion of your award and owing an unexpectedly huge tax bill, potentially one you can't even afford to pay from the net proceeds.
Okay. We briefly touched on why defendants often issue 1099s, even when the rules might say they aren't required for certain non-taxable amounts. Just to quickly summarize their perspective again.
Right. From the defendant's side, often their tax or accounting department just defaults to payment over $600 made in business, issue a 1099. It's often done out of an abundance of caution, driven by a fear of penalties for failing to file an information return if one might have been required.
They perceive the risk of a penalty for not filing as higher than the risk of a penalty for filing a potentially incorrect 1099, like one reporting tax-free money.
That often seems to be the calculation, yes. They might also, as we said, mistakenly think it's needed for their own deduction, which isn't true.
Even though, as that Wood LLP source pointed out, issuing a 1099 is not required for their deduction, and the actual IRS rules and instructions explicitly say not to issue 1099s for payments that aren't gross income to the recipient, like Section 104A2, physical injury compensation.
Correct. The source even argued that technically, issuing a factually incorrect 1099, like reporting non-income as income, could potentially lead to penalties for furnishing incorrect information, maybe even intentional disregard penalties in extreme cases, although penalties for failure to file seem to be the bigger practical concern for payers. But the guidance does say not to report payments that aren't gross income, or where the payer doesn't know how much is income.
But the practical reality is it can be difficult to convince a payer not to issue a 1099, even when the tax rules suggest it's not required or appropriate for the plaintiff's portion.
It can be an uphill battle sometimes, yes, which again points to trying to address it in the settlement agreement language itself, if possible.
This is clearly a really, really complex area, much more intricate than most people probably realize when they first see a settlement check.
It really is. You're weaving together the origin of the claim doctrine, specific tax code exclusions and inclusions, understanding different legal types of damages, the very significant and often painful impact of legal fees under current law, and then navigating the confusing world of information reporting forms like 1099s and W-9s. Not simple stuff.
Okay, let's try to distill this down into the most important lessons, the key takeaways for anyone who might be dealing with or anticipating a settlement.
All right. First, and most fundamentally, the taxability depends entirely on what the settlement is compensating you for. It's all about the origin of the underlying claim, not the size of the check or how it's paid out.
Second, damages for personal physical injuries or physical sickness and related compensatory amounts directly tied to that physical harm, like medical bills, lost wages due to the injury, are generally tax-free under Section 104A2.
But crucially, compensation for standalone emotional distress or physical symptoms that result from emotional distress that wasn't caused by a physical injury is usually taxable.
Third, watch out for the big carve-outs. Punitive damages and interest are the exceptions. They're always taxable as ordinary income, regardless of the underlying claim.
Fourth, other typically taxable recoveries include things like lost wages, not tied to physical injury, lost business income, and settlements from discrimination or wrongful termination lawsuits.
Fifth, for property damage, the recovery is tax-free only up to your adjusted cost basis in the property. You reduce your basis by that amount. Any amount you receive above your basis is taxable income, usually capital gain.
Sixth, and this is a huge one right now for 2018-2025, legal fees paid out of taxable settlements are generally not deductible for individual plaintiffs. This means you are taxed on the total gross amount of the taxable award, even the portion paid directly to your attorney. This can create a massive, sometimes devastating tax burden.
Seventh, regarding paperwork. Forms 1099 technically should not be issued by payers for non-taxable amounts like qualifying physical injury compensation or recovery of property basis. However, payers might issue them anyway out of caution.
And receiving an incorrect or unnecessary 1099 can trigger IRS scrutiny, forcing you to explain why the amount isn't taxable on your return.
Eighth, providing a Form W-9 with your correct SSN when requested by the payer is generally the smart move to avoid the severe complications and potential loss of funds associated with backup withholding.
And ninth, maybe the most important, the absolute key to navigating all of this successfully is proactive planning. Address the tax implications, how the payment is characterized, how it's allocated among claims, and how it will be reported before the settlement agreement is finalized.
10th, seriously consider consulting with a qualified tax professional who specializes in settlement taxation during the settlement negotiations, especially for complex or large cases.
They can help draft protective agreement language and explore sophisticated planning options like the Plaintiff Recovery Trust for cases involving large taxable damages like punitive awards. But remember, these tools absolutely must be set up before receiving the money. It's all about timing.
It's clear that navigating settlement taxation is complex, definitely counterintuitive in places, and can have major financial consequences if it's mishandled. This is really not a DIY project, is it?
Absolutely not. So if you receive a settlement or you anticipate one, the call to action is really clear. Find a tax professional who genuinely understands this specific niche area of tax law. Talk to them before you sign anything, and certainly before you start spending the money.
Getting that expert guidance up front is truly the single best step you can take to protect your net recovery and avoid nasty surprises later.
It's about making sure the relief you feel when the settlement check arrives isn't immediately followed by the shock and stress of an unexpected, maybe unaffordable tax bill.
Yeah. The difference between the gross settlement amount and what you actually get to keep in your pocket after fees and taxes can be pretty dramatic.
Hugely dramatic sometimes.
So, to leave you all with a final thought to ponder. When you consider the complexity we've discussed, and especially the sometimes incredibly harsh reality under current law of individuals being taxed on large portions of settlement awards that go directly to their attorneys, particularly for damages like punitive awards that are meant primarily to punish a corporate wrongdoer, does this current tax policy really feel fair?
It's a tough question.
Is this a system that truly serves justice for the plaintiff once you account for all the costs, including taxes on money they never really received? Or is it simply an unavoidable, maybe unfortunate byproduct of how our legal and tax systems interact today? And is it something that perhaps warrants serious reconsideration, especially as we approach 2026 when some of these TCJA provisions affecting deductions are currently set to expire or change?
It's a really complicated policy question with very real-world consequences for people's lives, something definitely worth thinking about.
The crucial question indeed. Thank you for joining us for this deep dive into the often confusing world of U.S. tax treatment for settlements and damages. We genuinely hope this has provided you with some valuable clarity and, perhaps more importantly, the motivation to plan ahead if you ever find yourself in this situation.